Okay, welcome back, traders. So what I want to do today is really just show you what I refer to as levels, and this is specifically around price action. Okay, so one thing that I can advise you to do is anything that you can learn on price action, focus on that. There is no silver bullet with any strategy out there, with any indicator. Price is king. Price is everything. Price tells you what's going on. You can see what the buyers and the sellers are doing. So use your indicators and trading strategies like Ichimoku and Bill Williams, which I'll cover later on, just as confirmations rather than putting everything on it. So you need to focus on price and price first and foremost. So you'll notice on this chart, which is the DAX. So we're sitting with the DAX, and I'm using a 4-hour chart for the DAX. You'll see this purple dotted line. That is a 200 exponential moving average. So I have that on pretty much every chart. And the reason I have it on every chart is because of that. Okay, let me just make, sorry, let's get rid of that. And let's make it red. Pretty big so you can see what I'm referring to. Okay, so if you look on this 200 EMA, can you see how price reacts whenever it gets the 200 moving average? So you can see rejection off there, bounce, a breakthrough, a retest of the breakthrough, rejection. So that happens pretty much on every single time frame you utilize. So remember, for my strategy, I'm only interested in the daily and the 4-hour time frames. Okay, so for me, levels are pretty much support and resistance and breakouts. So I have a different way of lining levels up. So I do use the Ichimoku quite extensively for levels as well, but I'll get into that in the next video. So for me, if I just put some lines on here, essentially what I'll do is every tail that I see, like there and there, where it glares at you in the face, that is pretty much where I'll first draw my levels. Okay, so let's do that, and just do another one. There's a nice long tail there. Okay, and copy, and then we'll do one over there. So now, let me just zoom in and explain where I'm going here. So essentially what price is trying to do is either go up or go down. It's that simple, Either guys are trying to push the price up or they're trying to make it cheaper by selling. So what you've got to understand is that every single tail that you see is a breakout. Let's put another one here because I see a breakout there. So every tail that you see is a breakout. Now zoom in some more here. Just get a real view on what's going on. So what do I mean by a breakout? So if you look at this, just put a little line in there. Okay, so you see this tail here, which was a rejection on the 200 moving average. It then came back off, hit the 200 again, sold off, bought, broke the 200, but more importantly, it broke this previous high. So price pushed up to this point, created a high, came off, tried to make another high, failed, came back down, and the bulls tried again to push, and this time they got through. And you can see this candle was quick, violent to the upside, because all the stop losses that were here, people who were trying to push the price down, got triggered, and now it's moving up. So what is going to happen is price will come back and test this breakout. And look here, it came back, found support at the breakout, and then continued rallying up. So I'll say it again, every single tail tells a story. It is a rejection either at the bottom or it's a rejection at the top. And as soon as you see that, if you break that level, typically the price will continue in the direction. Occasionally it does come back in, like as you can see here, come back to test this low again and then continue breaking it. But the rule of thumb on probably around about 70% of the time, it will always test that tail. Okay, so when I drew the lines, you see I drew a line there because of a prominent tail, and I've got one here. I can actually just move this one down to there. Okay, and even when you have a small pattern like this, so you see our price has gone sideways here, and it's using the 200 EMA as support, and it just keeps bouncing off you. Okay, you pretty much guaranteed that this tail will be tested sometime in the future, and it was. Look, there it failed, there it came, it succeeded. If you look to the left, you'll see this tail here, where my cursor is, was tested, and you'll see that the previous support level was tested here as well. Okay, so you've got to bear that in mind. So price is always trying to break higher or break lower, and essentially every tail tells a story. So the tail will be challenged. It'll either meet it for a double top and reverse, but more than likely it will bounce off it or break through. I mean, that's the simplicity of what price action is going to do. Either up or it's either down. Okay, let me just clean up a little bit. So if we move to the right here, you'll see here, this tail, look what happened to price here. It just hovered around here. As there's a bit of a tussle between the bulls and the bears to see who is going to succeed. And was it going to be a breakout, or was it just going to be a test of a breakout? And normally when you get a 4-hour close above the candle, it normally means that you've got a breakout that's pretty much going to happen. Okay, so you could start looking for entries for continuation. Sometimes it pulls back to the 50% Fibonacci, or it'll come back and test different levels. Okay, now one of the guys that I've learned my price action from is a guy by the name of Al Brooks, and highly recommend him. Difficult to understand, so you're going to have to watch him a couple of times and read his material a few times before you start grasping what he's at. But essentially, there's a lot of little things that he utilizes in price action, and it's quite interesting to see. And the one thing that I picked up and I use pretty much all the time is a thing which I refer to as Brooks gaps. So I'll just draw a line here. So what he's realized in the years that he's been trading is that whenever there's a Brooks gap, actually there's a better one here. Right. So you see this candle where my cursor is here, there is a tail at the bottom. If I draw a line across, and it drops down. So between this tail and that tail, so between that tail and then this candle's tail here, this open area here is what I refer to as a Brooks gap. So what Al Brooks says is that price will always come back to challenge this gap. And you can see what happens. Candle comes up, closes the gap, and then hovers a bit before it breaks through. So that is a level to me. So on the 4-hour chart and on the daily chart, those gaps are drawn in every time I'm looking at a chart. So not only will I draw a line on the tails, if I see a gap like that, I draw that line in as well. And what I'll do is I'll draw the line in. So let's just say there's a Brooks gap. And I'll just change that to, I normally use a blue to indicate a gap. So there's a gap. Copy that. There's another one. Copy that. And there's one that's open as well. So I'm going to keep it like that for now because I want to busy the charts too much. Okay, so one thing to notice, I am quite far back in the DAX at the moment, so we're talking about 2014 December period and 2016 January, and there's a reason for that, and I'll get to that just now. Just put another line in here, but this one I just want to make red, just so we don't forget it. I want to show you something towards the end of the video. So you can see how prices rejected this level, broken through, tested, tried to break through, broke through, broke back down, tested the break. So this level is a pretty strong level. Sorry, no editing a video here. Dogs doing their job. And so you can see how when this level gets broken, back to the top, down, now it gets tested with a double top basically before falling off. Okay, you can see the 200 moving average broke through, comes back to test. Again, price is always trying to go create new highs, new lows, trying to break through the moving averages, but it always comes back to test. May not be immediate. It may take a couple of weeks, it may take a few hours, but typically price comes back to test. The only time that we've really seen it is the last couple of years where, for example, the Dow, that's just been running, the S&P, it's just been running in a straight line up. So there's been a lot of levels that haven't been tested there. But you can see now the volatility that we've had this year, a number of those levels have come back to be tested. So rule of thumb is it's always coming back to test. So if I use this downtrend here, we can see it's in a downtrend. We've broken through this level, which was pretty important, and we've tested it twice. We have, from a signal perspective, I have a tail to the top. I've got a spinning top here. I've got confirmation. It's come back to test. I've now got an inside bar, which is a bearish signal. So that's two bearish signals at a level. That's an area to be short. Okay, and short, the first area that I would have been looking for price to do something would have been on the 200 EMA. You can see it broke through. So more than likely I would actually let it run for a bit longer, because then I'd look for the next level. So I'd look for Brooks gaps, and I think let's just make let's just add that Brooks gap in there and that one in there, so you can just see what happens. You can see how we break this level and we hit the Brooks gap, and then immediately we have a piercing pattern. The price is coming back up, test the break of the 200 moving average, and then continues through the next Brooks gap, through the level, and then hits the next Brooks gap, and then hits the next Brooks gap. So these gaps are very critical levels. So not only are the pin bars levels, but the gaps are also critical to look out for. So let's just tidy up a bit. And I'm just going to move some of these lines around. But what I normally do is, once I put the lines in, if I come back the next day or the day after, I will move those lines around. So you don't have too many lines all over your chart. But you try and keep the ones where you've got multiple touches. So when I say multiple touches, at least 3 to 4 touches on a level for it to be a pretty strong level. I just want to move that up to there. Okay, you'll see I've moved this one up to this pin bar here. Okay, so that's kind of what I refer to as levels. Then there is another element of levels which I use, which is ranges. So we all know that when a range breaks, price typically continues in the direction of the break for at least the height of the range. So what are we referring to? So this candle here, and I will draw a quick block around it. There we go. So that candle there is a range bar. So basically, if we were to drill down into the 5-minute or 3-minute, we would see price reacting up and down, between the low and the high of this bar. And these tails to either side indicate that it was a range bar. In other words, it touched here, went up, came back, and then sort of opened there and closed there. So essentially what's happening is the bulls and bears are having a bit of a tussle, and nobody's really getting the upper hand. But the very next bar, you can see we break out of this range with this big green engulfing candle. So these tails at the bottom are telling us a story that there are buyers. This nice green candle that closes on its high is telling you that momentum is up and it's pretty strong. So what I've learned about ranges is very simple. The 50% of the range is a very important area because often price will come back into the range and hover around 50% before breaking out again. And sometimes, it'll touch the top of the range and then it'll come back and it'll hover around here and then slowly, gradually move back to the top of the range before it breaks out. So I have modified a Fibonacci expansion in a tool inside my Pro charts where I have marked the 50%. The next element I mark is the 38.2% Fibonacci. I know it says minus here, but you've got the positive here and a minus up there. But ultimately the calculation is the same. It's a 38.2 Fibonacci extension of this range. Okay, why that's important is if you look over there, look there, how price rejected this level. But at the same time, this level here, there's a Brooks gap here, which it tried to stretch for, and it didn't get to. So that to me is already telling me that although this is the pin bar, the probability is we're just coming back to test the break because we missed that. We've got another magnet ahead, which is a 200 EMA. Okay. And we've also got the range height target, which is this 100%, which that is the height of this range. So for me, I would have been looking for on the retest of this. So I would have watched what happens in the retest, and you can see here you've got an inside bar, a bullish pattern, a bit more indecision here. That it would have been a good probability trade to take a long here. I could have left my stop right below this pin bar if I wanted to, or alternatively try to leave it below the 50%, which gives you a little bit more wiggle room. But anyway, we'll get into entries and stops and exits later on. So back to the range, you'll see the 38.2 extension is an important level. The 100% of this range is an important level. You can see that candle and this candle profit taking happening over there. And it also lined up with a tail. There's a tail, there's another tail, and there's a tail. So it's like a cluster of three tails that it lined up with. Let's just move this one because this here is a breakout. So we broke below that previous low. So we're expecting a retest of this area. And look, you can see we had a bit of a retest and then a breakout. The next level of a range, which is important, is the 161.8 Fibonacci expansion of that range. So this is typically where I will take profit on a range break. I'll take some profit here, but the bulk of my profit taking will be on the 161.8. Okay, now you can see what happened. Price got back to this level, which remember was pretty important, and we just sat and hovered around this level before we rejected and fell off again. Okay, so just delete my channel. Okay, so that's pretty much what I'm looking for in levels. And I think what I'd like to finish off with quickly is signals. So for me, signals are things like engulfing patterns. And let me just draw a block around there. So you can see I have a green bar, then I've got an engulfing red bar. So there's a probability that this trade's going to come off. Also bear in mind that price tends to do things more than once. So there's always a second attempt at a new high, second attempt at a new low, second attempt, or a second push down, or a second push up. So market loves doing things in twos. So it always helps just to wait. A lot of times you get into this area here and you think, I've got to go, got to get in now, and you get in. And if you look at this, I mean, this took, what was that? That was the 19th of December to the 30th of December. So for pretty much the whole of the Christmas week, you would have been sitting here getting worried whether you've made the right decision or not. Okay, so always wait. If you see the second signal, then you've got a really good signal. I mean, here you can see, here's my first signal, inside bar, another inside bar inside this red candle. It's a good indication, a range bar, and now a breakout of the range. So that's a really good signal. I can get in up here. Yes, it would be nice to get in at the bottom, but you know, you're sacrificing such a little bit for peace of mind more than anything else. Because as soon as it starts running, you would have left this 17th to 19th. So that's a 2-day trade that you could have left, and you had all your levels marked. So what I typically do is I'll have alerts at those levels, and I'll just watch out for those alerts to see what's happening, and just have a quick look on the phone. If it looks like it's breaking through, I'll leave it. If it looks like it's going to be turning, or the momentum is slowing down, I'll close the trade. So that's pretty much from the levels, and I think signals, pin bars obviously are pretty important as well, engulfing bars and inside bars. So there's my red, and then this green bar inside. It's a high probability trade to the top. And when these signals happen on a level, so this 200 moving average is a level, and look here, we've got an inside bar, we've got a pin bar, we've got another inside bar, we've got an engulfing bar. So that's 1, 2, 3, 4 signals at a level. So high probability trade here is as soon as this, I mean, even if you'd, sometimes if you'd taken this trade here, you would have wanted to be in on the top of the trade. So break of this pin bar there, and the stop would have been there. You would not have been triggered until this green candle here had broke through. And I think the last thing on this area here is we have a flag. You see we've got a downward flag, so, and pretty much a double bottom here as well. And I think on the other charts you would have probably seen diversions, and you would have seen some other signals on the indicator that we showed you to get in on this trade. And yeah, so I think the final thing is, the reason why I left this red line in is I just want to run through to the right. Let's just get this. Yeah. So I'll run through quickly, see how price behaves around that red line. Okay, so we broke way past it. Let's bring this back down. So you can see we broke quite high above it, staying with the 200 EMA, and then price just sat back where we've been working. And we are now almost a year later, and price has just stayed in that lane. You see that? It comes back to that red line. It acts as support resistance all the time. So every single time you draw a line at the bottom of a pin bar, it will line up, or the top of the pin bar, but it will line up with something that's happened in the past. Always. Okay? So, I mean, this is why I wanted to show you this from way back, because you can see how price behaves just in that area that we were working in, until we finally get a breakthrough and we move up to basically where we are today. Oops. So there you go. So this is why, to me, levels are the first and foremost entry or exit point that I have. If I'm not at a level, I do not get in a trade. And this works in all time frames, but again, I'm only trading 4 hours and daily, so those are the levels that I work with. It's pointless getting into a trade on a 5-minute trade and then trying to leave it and trade it like a 4-hour trade. You are going to get burnt. Okay. On the rare occasion, you may have it corrects on a major level, but it's very difficult to see a 4-hour daily level on the 5-minute chart. So that's the main reason why I'm using a much higher time frame. It just gives me more wiggle time, I think, for myself, really, and allows me to make better decisions. So, I mean, if you look at this breakout here, so there's another major level here. Okay. There's a lot of worry about the DAX. Is the DAX going to fall still? What's happening? Where are we going? Uh, Ultimately, if you just keep trading off the levels, your risk is going to be lower, because if you look at this breakout here, so there was a first attempt to break below this level. Okay, there's a second attempt. Now there's been 3 attempts at this. So the question is, are they going to succeed on pushing it through, or was that a failure? So going long at a level like this on the third attempt is fine. I mean, your risk is going to be probably less than 3%, which is great. And you can always add to your winning trades. So just bear that in mind. Okay, so that's kind of what I refer to as levels. And I think what I'll do is I'll get onto the Ichimoku cloud in the next video. And that will basically show you some of the levels that I utilize inside there in combination with price action levels. Anyway, hope that helped. Please remember to like, dislike, comment, ask questions, subscribe, and I'll do my best to answer those questions inside with the video. Catch you guys later. Cheers, man.